thank you so much for joining me today. We've got lots to get through, but for anyone who is tuning in, this is the basics of Forex and how to trade them. But before we get into the nuts and bolts of things, just a quick message of who we are and our why. We are real life trading, and it's our mission to enrich lives. We do this by educating the world on how to profitably, safely, and consistently trade the financial markets. What is the goal of this course? So the goal of this course is to ensure that you have a basic understanding of what Forex is and how to trade it. There is a lot of information around Forex out there, and I personally believe that some of the educators are trying to convolute your minds with complexity in order for you to either buy their strategies or sign up to their Forex signals and make it easier for you to trade. It is my goal is to combat that by giving you the necessary information in plain English in order for you to go and trade the markets yourself and be in control of your own destiny. So a little bit about me. Who am I? So I'm an ex-professional football player in the UK. I've played for teams like Colchester United, Gillingham, AFC Wimbledon, which was one of my favourite homes. So none of the big names that you guys were probably anticipating when I mentioned that, but enough when it was my full-time job. When I finished football, I did become a little bit of an entrepreneur. I've had many businesses, one in marketing, recruitment, and mergers and acquisitions. And I'm quite thankful that I've been through the process of starting a business and selling a business. And then I became a trader, and I've been trading for 2 years, nearly 3 years now in August 2021. My particular focus is, as we're talking about today, is Forex. I am a father of three. I have 3 children under the age of 7, and you can probably tell by the bags in my eyes in the photo that's the reason why. Lack of sleep. I have a 1-year-old who keeps us up most of the night. I am a wine lover, in particular the red variety, and you can tell from my accent that I am from London and now I live in Spain. So what are we going to be learning today? So basically the course is going to be broken up into 3 modules, and that's going to be split across the 3 days. Module 1, which is today, we're going to be talking about what Forex is. We're going to be diving into pips and what they are. And the most important part of today's lesson, we're going to be talking about lots, leverage, and margin. And that is the most particular point I want everyone to have a special focus on, because when you get your head around that, then we're trading Forex. That's it. It's more important, I think, at this particular time than your actual trading plan. It's just getting your head around that. Module 2, we're going to be looking at what it costs to trade Forex, because we can't always focus on how much we've won or lost in a trade. We have to figure out what's it going to cost us to do that, and that gives us a more educated decision and where we place our stops, entries, and things. We're going to be talking about the types of analysis, similar to stocks, fundamental and technical analysis. And we're also going to be looking into candlestick patterns, and in particular, my favorite pattern that I look for. And then module 3 is where it gets exciting. We're going to give you, as a bonus, a trading plan that I have tried and tested, and it works when followed. So we're going to give you that for free. We're going to show you how to use that. We're using some real life examples. And then I'm also going to be giving you the times when you shouldn't be trading. And then at the end, we can have a Q&A. So before we get into it, I just want to give you 3 really quick reasons why I decided to trade Forex. And we'll go into each of these in a bit more depth later in the program. But the first reason why I like Forex is, 1, it's a 24-hour market. So if you're like me and you have a young family and you're running a business and you're trying to trade, then a lot of factors can change in my day, and my days are never the same. So to be able to flip up my laptop at no matter what time to try and earn my cash flow, which is what I use Forex for, is to create cash flow to pay for my bills, then that was appealing to me. I love the liquidity of the market. So, that's phenomenal for me when I'm getting in and out of a trade, that there is always someone in the market who is opposite to me in a position that is willing to take the price that I'm looking to get in or out at. And the most important, again, would be the leverage, which is a scary term, and we'll combat that later on in the program. But the reason why I like leverage, it allows me to trade a bigger account than I actually am able to physically in cash. So it gives me access to a large amount of exposure in terms of capital. It's great if you've got a small account, but also, like I said previously, if you follow me at all on social media, is with great leverage comes great responsibility. So the same way we can take advantage of leverage by maximizing profits, you can also maximize your losses. But don't worry, we're going to go through that in a bit more depth later and tell you exactly how you can combat that. That brings me to module 1. Let's dive right in and get through the nuts and bolts. So Forex, what is Forex exactly? So Forex is short for foreign exchange. It's when one currency is exchanged for another. Forex transactions have a colossal $5 trillion a day in daily turnover. A large portion of volume is traded through Forex speculation, which is what you and I are going to be doing. And we'll go into that a bit later. You can trade Forex 24 hours a day, 5 days a week, which is what I said. And it's high leverage trading with low margin requirements. So that's Forex in a nutshell. I think the biggest way or the best way that people can comprehend Forex is when you go on holiday and you find one of those booths that you can exchange your home currency in, and they will give you the currency of your destination and whatever the value of that currency is in comparison to your home currency. Now, don't worry if that confuses you right now with that sentence. This is going to be part of the training, so we'll go into that in a little bit more depth. But in a nutshell, that is what Forex is. So why is Forex particularly attractive in trading? Again, keep harping on about it, but it is a 24-hour, 5 days a week market, which means that you can trade around your lifestyle, which is entirely important if you're busy, or this is a way of creating a second or third income stream for yourself. You don't have to be glued in front of a computer 24/7. You can pick and choose your hours, and we'll talk about how you can best combat different currency pairs with that. It is high leverage trading with low margin requirements, which again allows you to earn more money per trade. It also allows you to have a bigger position with a smaller account. So it's phenomenal for people with small trading accounts. There's no PDT rule, so you don't have to worry if your account is under 25,000 like you do in stocks, and you're only allowed certain amounts of round trips when you're entering a trade. That does not exist. You can enter as little or as much as you want per trade. So fantastic if you're starting off. Trading hours and why they are important. Okay, so different countries are more active at different times. Okay, that might seem like a very simple and obvious statement, but if I can break it down in terms of how that relates to Forex, is if you're looking for action and price action, which happens a lot in Forex, and you're in London, and so the main things that you're going to be wanting to trade is the London session. So, that's between 8 a.m. to 4 p.m. every day, UK time. But if you're getting home around like 6 o'clock in the evening and you want to trade sterling or the euro versus the sterling, then there's not going to be much action there, because both of their working hours in quoted commas have finished. So bankers have gone home, traders have probably stopped for the day. So you're not going to get much action. So you're best off looking at what currency pairs are correlated with working hours in terms of each time zone. Does that make sense? So if you're in the United States, then you're best off trading something that has the US dollar in rather than something that doesn't, for example. Does that make sense? Cool, perfect. Okay. The Forex market opens and closes in sequential sessions. So like I just mentioned, the first session is considered London session, then followed by the European session, which starts an hour later. And then you've got the New York or the American session, and then followed by the Asian session. So, and it runs sequentially on each other. You can get the exact hours. It does change between summer and winter times, but you can get the exact hours if you go onto a website called forexfactory.com. It's got everything laid out for you there. You can go on there and it's like a little timepiece that shows you which sessions are in session. I don't want to use a better word, but that's all good information there. And I'll give everyone a link to that after we've had the course. So the opening and closing of these sessions can impact due to volatility. So very similar to stock trading. If any of you have ever traded stocks before. So we always know that we're going to get some high volume of trades at the beginning of the day and at the end of the day. People are getting in and out of positions from the previous day, or they're closing positions or setting up some swing trading at the end of the day, right? So it's very similar to how the sessions work in Forex. You're always going to get a lot of volatility and a lot of volume at the beginning of a session, and you're going to get the same at the end of a session. So it is quite important that we look at those and just bear that in mind, just so we're aware if there's any volatility that is happening, that we're actually in a position where we can control that. Okay, so just be mindful of that is what I'm trying to say. Like I said earlier, you can open your laptop, pull up a chart at any hour and trade. So 24 hours, 5 days a week, you can trade Forex, and you're not going to be governed by, like I said in the last point, there is no rush to open or close trades before a closing bell. So really good information if you have a busy lifestyle or you're looking to create a second income or a third income equally. So currency pairs. So in Forex, currencies are quoted in pairs. So you have a value currency, and you value that currency in comparative to another currency. Now, what does that mean? So if I am in the UK and I have £1, I know that in England that is worth £1. But how much is that pound worth in another country and in comparative to their currency? So that's where the exchange comes in, and don't worry, we're gonna go into that in the next slide. So if that's a bit of a mind-blowing opportunity for you guys, it shouldn't be in modern day. But when looking at a currency pair, this is important information for those of you who have never traded Forex before. So when we're looking at a currency pair, the first three letters of that pair is known as your base currency. So if we take the top one, for example, we've got the CAD versus the CHF, which is the Canadian dollar versus the Swiss franc. The CAD, the first three letters, that's your base currency. And that is what you're going to trade on. So you're going to decide whether you think that the Canadian dollar is going to go up or down in comparison to its quote currency, which are the second three letters. Simple. And there's a lot of things that we will talk about in module 2 of, the factors of how we can decide whether we feel like the base currency is going to increase or decrease against the quote currency. If we're going to hold positions for a longer term, there's all these different economic factors. We'll go through that in a little bit more detail, but for me, I'm a pure charter. So, I look at the charts and I look at candlestick patterns. And again, that is something that we will touch base on later on in the program. But for now, all you need to know is the first three letters are your base currency. The second three letters are your quote currency. And we will decide what we do on that later on. So we're still on currency pairs. Let's just take an example for now. Using GBP and USD, which is one of my favorite currency pairs to trade. So if we know that the GBP is our base currency and USD is our quote currency, then the rate is simply how much of one unit of base currency is worth when exchanged for the quote currency. So like I used that analogy earlier, in the UK, I know that £1 is worth £1, but how much is £1 worth when I'm traveling to the States, right? So when this was recorded, it was, when this was designed, I should say, the current rate for GBP USD was 1.37144. So you can see that there, right? And this would be a sell price when you're looking at it from your broker perspective. So you always have your buy price first, and your sell price is normally buy and ask or bid and ask. Varies, but the first one is going long basically, and the second number is going short, which we'll touch on in a minute. But what does it actually mean? It literally just means that GBP, £1 of GBP is worth $1.37. And that's what it means. So in a nutshell. Yeah. So good question. So when we're looking at these currencies here, and it's a good point actually. So if I take this away, so when you look into your broker, you will see numbers like this. Now we are going to touch upon this later, but when we're looking at these type of figures, you have a fifth number here, and this is called a pipette. Okay. Now pipettes are not widely used. Some brokers use them, and that's why they're there. So my advice to everyone is always forget this fifth number. Just ignore that, it means nothing. Okay, we're going to go on and talk about that a little bit more in the course, but just for now, just remember that 1 GBP is worth $1.37. Cool. Anyway, sorry for those of you that are watching this on a recording. We still have people here live, so there's some questions that need to be answered. But we're going to cover all of the questions in these next slides, and we're here now, as fate would have it. So cool. So when currency pairs to take long or short trades, right? So we're using currency pairs to take long or short trades. So just like in the stock market, you can go long or you can go short. So we can be buying or selling or going bullish, going bearish, all means the same things, right? So for example, using our example, if we're saying that we want to go long on GBP versus USD, what does that actually mean? So that means as speculators and as traders, we believe that the GBP is going to increase against the dollar for whatever reasons, okay? Economical reasons, charting reasons, we're going to get into that, but essentially we believe that that's going to go up. So when we're buying the base currency, we are automatically selling the quote currency. Okay, so we're buying one currency and selling another, and we want the price to go up because we're going long. So essentially, we want to own more dollars for the same amount of pounds that we're spending. So when we spent earlier on, we had £1 that was worth $1.37. Our target is to make sure that that pound becomes $1.39 or $1.40, and then we're selling that at that price and netting the difference. And that's how we make profit as speculative traders. Does that make sense? Cool, perfect, excellent. So what happens when we want to sell? So conversely to that, if we believe that the GBP is going to weaken against the US dollar, then we would sell the base currency and buy the quote currency. And then we would net the difference if the price dropped. Okay, so exactly the same, just on the flip side of things. And we would also do that type of trade. So for example, if we felt, that the US dollar was going to increase against the GBP, then you would still sell the GBP, okay? Because this is just the way it's formatted. You would never find like a USD GBP symbol, okay? It's always the way we just said it just now. It's always GBP versus USD. So if we believe that the GBP is going to weaken against the US dollar, then we would sell, and we would also sell if we felt the US dollar was going to be stronger than the GBP. So it means the same, okay? So, I know there's some confusion on that, but that's just how it is, and you're never going to find USD GBP. It's always going to be GBP USD, and then you just decide where you feel what you think the base currency is going to do. So if you think it's going to increase, then we go long. If you think it's going to decrease against USD, then we go short. This is where it gets interesting, right? We've heard this terminology many times, and being British, we do say this when we say goodbye. We say toodle pip, okay? So, but what does it mean in terms of Forex? So, okay, sometimes pips can be referred to as points, just to get that out. Same thing, just different terminology. So A pip is a measurement unit used to indicate changes in the rate of a currency pair. Pips are used by traders to calculate how much that they have won or lost on a trade. And in practical terms, a pip is 1/100% or the 4th decimal point. So essentially a pip, I would like a pimp, but no, a pip, I should say, is the smallest amount of increase in price or decrease in price. It's just a price movement. In layman's terms, it's price movement, okay? I'm going to figure out how much that's worth in a little bit, but essentially we look at all pip movements as the 4th decimal place. That's why it's important that we forget the 5th number that we spoke about previously, the pipette, because throughout the world, people talk about pips and points as the 4th decimal place, except for one currency, okay? And that currency is JPY. And why this is, I do not know. And there's probably some historical thing that happened, and it's maybe more famous than I could ever imagine, but I have zero clue why this is. But for JPY, it's the 2nd decimal place. So the value of the pip is the 2nd decimal place, not the 4th. And if you look over to your left of the screen, where we have it here, so you can see the euro, it has 0.6644. So essentially the 4 here is your pip movement, and we're going to look at that. JBP, as you can see, or JPY, I should say, is here, 109.00, and you can see that the decimal place is in an entirely different position. So that's how we look at that. So when this increase, we're looking at this price here, this number here, and then that would govern to us the pip movement. So if that goes to 0.1, then it's moved to 1 pip, where if this moves to a 5, then it's moved up a pip. Okay, does that make sense to everyone? Yeah, and yeah, good point actually. And that does bring me, anything that is traded with JPY will use the 2nd decimal place, no matter what it is. Okay, so anything that is traded with JPY is the 2nd decimal place, or you're looking at that, right? Correct, that's it. And everything else is the 4th. Just a little curveball that I think they try to throw at us to keep us on our toes. But once you get your head around that, then yeah, it all becomes easy. Cool. So we're still on what is a pip. So let's talk about what that means in terms of how you calculate your pips and things. Okay. So we're still on the GBPUSD. We're still going to use that as our example. So forget these numbers at the moment. We're going to make it really, really simple and easy, mainly for me to explain. You'll get your head around it at some point. So let's say that we're going to take a long position on GBP versus USD. So we believe that the GBP is going to go up and the USD is going to go down in price. We think the value is going to be with the sterling. So the price at the moment is 1.3550. Okay. Now, these are numbers that we're going to focus on. We're going to focus on these two numbers here. And by the time that we close our position, the price now is this number here, which is 1.3600. So that is a 50 pip increase. And if we've gone long, then that's a 50 pip profit. Okay. And you can see it's gone from 550 to 600. So that's 50 quid or 50 pips, sorry, not 50 quid. So it's a 50 pip profit. Okay, so we're now up 50 pips, which is a great trade. But what happens if we short that position? Well, it's the exact same. So with the same price, we're looking at this price here, which is 1.3550, but we've gone short. The price still moves up to the same price as 1.3600. So we lose 50 pips. Very simple, very basic. Easy to understand when you know how. Don't get confused with all the blinding numbers. You just need to focus on the 4th decimal place, and then that will help you figure out the pip increase and the pip movements. Does that make sense? I should do what Jerry says, to type 1 in if everything's on track. Lots of ones, lots of ones. Wow, good stuff, team. Well, let's crack on then to probably the most important part of understanding pips. And the question that everyone wants to know is, how much is a pip worth? Right? Okay. And that's important for us. We want to know how much profit or how much loss that we've had during trading. And that's the real question. So, full disclaimer, you can use this formula to calculate your pips. However, there is plenty of softwares out there now, as we do live in 2021. You can just input your entry and your targets and where your stop losses will be, and it will calculate all the pips for you and how much it's worth at the time. And your broker should offer you that facility as well. But it's always good to know how these things are calculated, just in case technology collapses on us and we have to start using pad and pens again and using pigeon carriers to get our orders to our brokers. Okay, so let's just humor this section for now. So first of all, we have to determine the pip value. And then once we have that, we divide that by the current exchange rate, and then we times that by the lot size. Now, I know we've not covered lot sizes as yet, but we will be. So just bear with me for now. Okay, so we learned in the previous slide that 1 pip is the value of the 4th decimal place. So we know that. Let's say we're using the example again, GBPUSD. And the exchange rate is 13,450, so 1.3450. So that's the exchange rate that we got. We're going to use 1 standard lot size, which is the equivalent of 100,000 units of base currency. So in this particular example, it's going to be £100,000 sterling, GBP. So once we have that information, then we move on to how we calculate how much each pip is worth. So we take the 4th decimal place, which is the pip value. We divide that by the exchange rate, which if you remember, it was here at 1.3450. And then we times that by the lot size. And in this case, it's a standard lot, which is 100,000 units of base currency, which is sterling. And that gives us this total. That gives us a pip worth of £7.34. So every time the price moves in a direction, it's either going to give us £7.34 or cost us £7.34, depending if we've gone long or gone short, and if we're in profit or out of profit. Okay, so now you can start to see how you can grow a small account by using Forex, because if we take the previous slide where we made a 50 pip profit, if we times that by £7.34, then we get a grand total of £371.74. So on this particular day, using GBPUSD, if we had a trade that made 50 pips at that exchange rate, we'd be sitting on £371.74 of profit. And I don't know, if you're anything like me, then that's not a bad day. There's a lot harder ways to earn £371. So you can, as I said earlier, you can really start to see that how you can use leverage to your advantage if you have a smaller account, because you can trade higher lots and with a low margin requirement. But equally, you could lose £371.74 if we lost 50 pips like we did in the previous slide. So when we get onto that point, we'll talk about how you can mitigate against your risk, so you can always try to see upside potential. Next slide. Perfect. So great timing. So now we understand what Forex is and how it works in terms of currency pairs and pips. This is the most important part of Forex. This is what brings all the information together, and it's understanding what lots, leverage, and margin are. So I am going to go into each of these categories in more depth, but just in a nutshell, so we can start to understand from a top level perspective, is lots are considered a measurement of currency units. Leverage is a kind of interest-free loan provided by your broker. And margin is your good faith deposit in order to open and maintain positions. So in a nutshell, that's what it is. But let's delve deeper and go into it in a bit more depth. So if we're looking at lots, so in terms of lots, a lot is a unit measuring a transaction amount. So when you place orders on your trading platform, orders are placed in sized, quoted in lots. So just terminology, really. So just get used to lots is what you're going to be trading. Okay. For those of you who are new to trading and don't have any other experience, if you can imagine, especially in the UK and in Europe, when we buy eggs, they normally come in boxes of 6, 12, or 24. So just imagine that that's what you're going to be trading. You're going to be trading certain types of packages. For my option traders out there, and the best way that I can describe to you guys is that when you trade options, you are buying one contract, okay? So when you buy one contract in options, what does that control? So one contract in options controls 100 shares, right? So terribly you start writing that, but so one contract in options controls 100 shares. So it's very similar to Forex. It's the exact same, right? You're just controlling an amount of currency, the same way you would control an amount of shares. And it's literally broken down the same. And what are those lot sizes? So here they are. You get a standard lot size, which is 100,000 units, a mini lot size, which is 10,000 base currency units. And then you can get micro lot sizes, which are 1,000 units of base currency. You do offer now nano lots, so which is just 100 units of base currency. So, there's the barrier to entry when trading Forex is very small. So you can start off with a very, 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 very minimal account, and you can see how you can trade that. The only difference I would say, that really stands out for me when we're talking the difference between options and how options are sort of run or traded, I should say, than Forex is you can't buy part of a contract in Forex, in options. So I can't buy half a contract in options, and I can't control 50 shares. That's not allowed. I have to have a minimum of like one contract, which is 100 shares. In Forex, you can control part lots. So you don't have to have a whole lot. You can have 0.1 of a lot, you can have 0.2 of a lot, all the way up to 0.9 of a lot. So you can literally just tweak your lot sizes in order to mitigate your risk, so you don't have as much capital exposed in the market at one time. Does that make sense? It's really important that we get our heads around this, because this is vital when we come to trading, and especially for mitigating risk. So type in a 1 if that is making sense to everyone. Perfect. Good stuff. Lots of ones. Love it. Excellent. Cool. Well, let's move on. It was all going far too well, wasn't it? All going far too well. Resume share. Perfect. Sorry, guys. Yeah. I thought things were going too smoothly. Nothing ever runs smoothly when it's me. Excellent. Well, this is real life, right? So, no, nothing fake here. Cool. Leverage. So, like I said before, look, leverage is not the devil. Leverage is not the devil. Leverage is your friend. Believe me, it's worked phenomenally for me, and I'm going to show you how. So leverage basically permits you to trade more units without having to have the actual cash. So a really good example of this is if you wanted to buy shares in, let's say, Tesla, for example, and I'm not sure what the price of Tesla is today, but let's just say for argument's sake that Tesla is worth $300 a share, okay? So if it's $300 a share, I physically have to have that $300 if I want to purchase one share, okay? If I want to purchase one share, or, if you're talking about options, and I know that's 3 contracts, but just for simplicity's sake, right? You have to have $300 to buy that. I don't have to have £100,000 if I wanted to control 100,000 units of base currency in Forex. I don't have to physically have that cash. So that's where leverage comes in. And effectively, as I said in a few slides ago, your broker gives you a quote unquote interest-free loan on that. They don't physically give you the money, they just permit you to trade a higher amount of currency units. So Very important to understand. Leverage governs the amount of lots that you can control in the market, founded on the capital that you possess in your account. So we're going to talk about margin after, but they go hand in hand. So depending on how much margin or how much cash that you have in your trading account will depend on how much leverage your broker gives you, which will then govern how much base currency you can control. Okay, so very simply to understand, right? Cool. The higher the leverage, the more capital you are exposed to risk. So like I said, if your broker there are some brokers in the UK and I think in the States that you can get like 100 to 1, right? So what that means is that there's an example down here. If your broker is going to give you 100 to 1 leverage, that means that you can have £100 into your account or $100 in your account, and you can have a position in the market of 10,000 base currency units. So you can start trading 10,000 pounds or dollars or whatever base currency units that you want to, with only 100 of it. Because essentially for every pound or dollar that you put in, your broker is going to give you 99 to make up the 100. So you can see how you can really maximize your profits by using leverage. But again, you have to play devil's advocate. The same way that you can maximize profits, you can maximize losses. And how do we, reduce our exposure to the market? Good question. We're going to talk about that now when we talk about margin. The margin. So margin is the deposit required by your broker to cover your positions that you have entered in the market. It goes hand in hand in leverage, like I said, you can't have one without the other. And margin is used to maintain your position and cover any potential losses, okay? So how do we then mitigate against our risk? So just before we go into that, let's just go through this example. So here we have a leverage of 100 to 1. So when we said that our broker is going to give us the 99 and you're going to be responsible for the 1, that's a simple math. So all you need is that 1, or in this case, you need 1% of 100 to manage to enter a trade or to take a position. So if you're trading the mini accounts, then in order to have a place in the market of a position of around 5,000 base currency, then all we need to have is 50 quid. We need £50 or $50, whatever we need. So that's how leverage is used, and our margin is £50, and our leverage is 100 to 1. So we can control £5,000 of any base currency position. So key things are, how do we mitigate against our risk with that? So let's take my actual example. This is my actual leverage that I get from my broker. So I get 30 to 1. Okay, so I can have 30 times my margin. Okay, so I know that if I need to control 100,000 base currency units, I need to have in my account at one time, which is held as margin, I'm going to do it in pounds because I'm English, is 3,300 and all the recurring fees. So whenever I take a trade using one lot, which is supposed to be a 1, which is 100,000. So one lot is £100,000 that I'm going to trade. I need to have in my margin account 3,300 and all the fees. Okay. So what does that mean if I lose on a trade? Do I lose that if I'm wrong? And the answer is, of course, no, because I use something called a stop loss. Now I'm going to I'll hold my hands up openly and say, before I started trading, or before I found real life trading, and before I had coaching sessions with Jeremy Newsom and things, I never heard of a stop loss. So I dabbled in some Forex before I even started trading full time. I did it when I had my company in the UK, and only small amounts, but I blew up my account twice, I think maybe even 3 times, because I never used stop losses. So what does that mean is, for anyone that is trading and figuring out how does that happen? So basically what I do, I decide what I'm prepared to lose on a trade. And let's just say, for argument's sake, that my risk unit is 100. So if I'm happy to lose 100 on a trade, because that's my risk unit, then all I need to do is go back and use the pip system that we did previously to figure out how many pips from where I place my entry equates to 100 pounds, right? So I'll look at my entry and then I'll figure out how many pips between my entry and so for example, if I want to go long, okay, if I want to go long, so I'm trying to go up in price, let's just say that the price is, for argument's sake, 120, and that's where I want to enter, and I think the price is going to go up. I would then calculate using the pip system or the pip formula to figure out that if I'm wrong, how many pips below 1.20 equals 100, and then that's where I'd place my stop. So if I'm wrong on a trade, then I lose £100 out of my account, which if I've got a 5k account and I lose 100, then my account's down to 4,900. That's it. Yes, I've had to make sure that I've got 3,300 and all the threes as margin and a deposit to take the trade, but my broker will deposit that back minus the 100 that I've lost. Because now is the time to ask questions, because that's the end of module 1. And I did say right at the start, I will do my very best to get you out before the hour. In tomorrow's session, if you're live, and if you're not, if you're looking this on or watching this on a recording, module 2, we're going to be talking about the costs that are involved with trading Forex. So that's equally as important to know as making profits, is how much is it going to cost you to trade. We're also going to be talking about some fundamental analysis and looking at, in particular, some candlestick patterns. And then moving on to module 3 is the day that I think there is a lot of excitement for. We're going to give you the trading plan, go through that trading plan so you fully understand it, and show you what it's like in some real life examples. And then I'm going to give you some times where you should avoid trading Forex, and then that should be us, job done, ready to go live and start making some profits. So just before we close up, anyone that is here now, any questions for me? Anything that you want me to run over again? Everyone's saying they're good, perfect. Well, look, for those of you that are already part of the real life trading community, then if you need anything, then drop me a message on Slack. For those of you that are not part of the real life trading community, first thing, come and join the real life trading community, because you don't know what you're missing. But if you're not part, then you can, if you're not part of our tremendous community, then you can reach out to me at dean@reallifetrading.com with any questions that you have. Well, guys, thanks so much for being here today. I look forward to seeing you all tomorrow. Love life, live life, and trade it. Have a good one. Toodle pip.